For 14 straight years, every time Ontario needed to raise money on the US dollar bond market, an American bank was in the room. That streak just ended quietly, with almost no fanfare, in a $2 billion bond deal that Bloomberg had to specifically flag because of who wasn't invited. No JPMorgan, no Bank of America, no Wall Street at all. Just a British bank and 3 Canadian ones, splitting a deal that used to belong to American finance almost by default. And Ontario wasn't even the only province doing this. This is what it looks like when the biggest financial institutions on Earth start quietly losing their grip on a market they assumed was permanently theirs. Here's what we're covering. First, we'll break down exactly what happened with Ontario's bond sale, the specific banks involved, and why the 14-year gap matters so much. Then we'll get into Alberta's almost identical move months earlier, dropping a bank it had used for 6 straight years. After that, we'll cover the moment this stopped being just a Canadian story, when JPMorgan's own CEO Jamie Dimon publicly admitted his firm had lost real deals over this exact tension. We'll look at the bigger borrowing numbers behind all of this because Ontario alone is moving tens of billions of dollars through this shifting landscape. We'll dig into how bond syndicates actually work behind the scenes, because understanding the mechanics here is what makes this story land. And finally, we'll get into what officials actually say about all this, because a fair breakdown means including their side too, even when the pattern still speaks for itself. Let's start with Ontario, because Bloomberg's own reporting laid out the numbers in stark detail. The province sold $2 billion worth of 10-year bonds, and for the first time since 2011, not a single American bank was part of that deal. Instead, Ontario turned to British banking giant Barclays, working alongside 3 Canadian institutions, BMO Capital Markets, CIBC, and Bank of Nova Scotia. This wasn't a province with no history working with American banks either. Just months earlier in January, Ontario had used Bank of America to help sell $3 billion in 5-year bonds. So this was a real, visible pivot, not an accident of circumstance. A province that had an active American banking relationship and then very publicly moved past it. According to Wealth Professional, the deal actually generated record interest for an Ontario 10-year USD offering, meaning investors didn't punish Ontario at all for leaving Wall Street out. If anything, demand went up. That detail alone undercuts one of the most common assumptions people make about moves like this, that stepping away from the biggest American banks would somehow spook the market or make borrowing more expensive. It didn't. If anything, it proved Ontario's credit was strong enough that global investors showed up regardless of which banks were running the syndicate. Alberta's story runs on an almost identical track. In March, the province sold $1.95 billion worth of 10-year euro-denominated bonds using Barclays alongside RBC Capital Markets and TD Securities, again with 0 American banks anywhere in the syndicate. That mattered because Alberta had regularly tapped Bank of America for its Eurobond sales for years before this. Then in April, Alberta went even further, issuing a $1.4 billion bond entirely without Bank of America's involvement, the first time that had happened in 6 straight years. 2 of Canada's largest provinces months apart, both quietly stepping away from the exact same category of American institutions they'd relied on for the better part of a decade, right as Trump's tariff threats and Section 232 national security claims against Canadian industry were escalating in Washington. It's worth pausing on just how unusual this timing is in the world of sovereign and provincial debt. Bond syndicates are typically sticky relationships. Banks compete hard for these mandates because winning one deal often leads to being invited back for the next one, building years of institutional trust between a Treasury Department and its underwriters. For 2 separate provinces to break multi-year, in Alberta's case, multi-year and specifically 6-year, relationships within months of each other isn't the kind of thing that happens through simple random rotation, even if that's exactly the explanation officials have offered publicly. And here's the moment this story stopped being something only Canadian financial reporters were tracking. JPMorgan CEO Jamie Dimon said in April that his own firm had already lost, in his words, a couple of bond deals tied directly to the uncertainty created by the tariff dispute, though he stopped short of naming which ones specifically. Sit with that for a second. The head of the single largest bank in the United States felt it necessary to publicly acknowledge that trade policy coming out of his own government was costing his firm real underwriting business. That's not a claim from a Canadian finance minister trying to score political points. That's an admission from the very top of Wall Street itself. Dimon runs an institution that manages trillions of dollars and has weathered financial crises, currency collapses, and decades of geopolitical turbulence without needing to publicly comment on individual lost mandates. The fact that this specific dynamic, tariff-driven friction with Canada, was significant enough for him to bring up voluntarily tells you it wasn't a minor, forgettable blip on JPMorgan's radar. Now, to be genuinely fair here, because this story deserves honesty rather than pure spectacle, provincial officials have pushed back hard against the idea that any of this represents a formal, deliberate policy. Alberta's finance ministry spokesperson said plainly that the change with Bank of America was not intentional. Ontario's own finance ministry spokesperson, Colin Blanchard, stated the bond deal was part of regular bond rotation and that U.S. banks were in no way deliberately excluded, adding that bond issuance runs through the Ontario Financing Authority, an arm's-length organization from government itself. The Globe and Mail confirmed there is no blanket ban on U.S.-based financial institutions, with officials describing it instead as continuously monitoring and assessing the performance of service providers and adjusting the borrowing syndicate accordingly. That distinction matters, and it's worth remembering that at least one other Canadian province, British Columbia, continued openly using American banks for its own bond deals around the same period, proving there's no coordinated national policy forcing this shift across every province simultaneously. But even accepting all of that context at face value, the political backdrop makes the pattern hard to dismiss as pure coincidence. Ontario Premier Doug Ford had already publicly pledged, back in early March, to ban American companies from all Ontario government procurement contracts until Washington removed its tariffs. So even if this specific bond decision wasn't an explicit directive from Queen's Park, it's landing in a political environment where the province's own premier had already floated exactly that kind of sweeping exclusion out loud, on the record, for an entirely different category of government spending. When the head of a provincial government is already on record talking about banning American companies from contracts, and then that same province's finance authority happens to rotate away from American banks on its biggest bond deals in over a decade, officials get to call that coincidence, and observers get to notice the pattern. Both things can be true simultaneously. Here's where this becomes bigger than a couple of individual bond deals, though. Ontario alone plans to borrow nearly $60 billion this fiscal year to cover its budget deficit, with up to 30% of that, close to $13 billion, expected to come from foreign markets rather than domestic Canadian buyers. Every one of those foreign transactions is now effectively a decision point. Does an American bank get a seat at the table this time, or does a European or Canadian one instead? Given everything else happening in this relationship, tariffs, national security claims against Canadian steel, and premiers openly discussing banning American companies from public contracts, it would honestly be more surprising at this point if American banks weren't gradually losing ground in this specific market. Let's talk about why bond underwriting actually matters so much in the first place. Because on the surface, it might sound like a minor technical detail buried in a government finance department. When a bank gets selected to help lead a bond sale, it isn't just processing paperwork, it's building relationships with the global investors who ultimately buy that debt, earning underwriting fees that can run into the tens of millions of dollars on a single large deal, and positioning itself for future business ranging from currency hedging to advisory work to being first in line for the province's next borrowing round. Banks compete aggressively for these mandates precisely because winning one often becomes a multi-year, sometimes multi-decade revenue stream rather than a single transaction. Losing a lead role on a provincial bond syndicate isn't like losing one order of goods. It's losing a recurring relationship that compounds in value the longer it lasts. That's exactly why this shift matters more than its dollar figures alone might suggest, and exactly why a bank as large and battle-tested as JPMorgan would bother mentioning it publicly at all. There's also a broader question worth asking here. Why would Barclays specifically be the beneficiary across both the Ontario and Alberta deals? Part of the answer likely comes down to simple opportunism, when American banks find themselves politically toxic or simply less competitive due to the trade environment. A well-capitalized European institution with strong ties to both London and Canadian capital markets is perfectly positioned to step into that gap. Barclays has spent years building out its North American debt capital markets presence, and appearing as the common thread across two separate provincial bond deals within the same several-month window suggests the bank recognized an opening and moved quickly to capture it. Exactly the kind of market dynamic you'd expect once American institutions start losing their default advantage. There's also a broader Canadian policy backdrop worth connecting to this financial story, because it doesn't exist in isolation from everything else happening in this trade war. Ottawa and several provincial governments have rolled out formal Buy Canadian procurement policies over roughly the same period, prioritizing Canadian suppliers and materials on public contracts above a certain dollar threshold. While those specific policies target physical goods rather than financial services, they reflect the same underlying instinct now showing up in bond markets, a systemic reassessment of which relationships Canadian institutions, public and private, actually want to depend on going forward. A province that's telling its infrastructure contractors to prioritize Canadian steel and lumber isn't operating in a completely separate universe from a Treasury Department quietly rotating away from American banks. Both reflect the same broader mood. An entire layer of government slowly reducing its exposure to a relationship that's become politically unpredictable. It's also worth noting how this fits into the currency composition of Canadian provincial debt more broadly. Provinces routinely issue debt in multiple currencies, Canadian dollars domestically, US dollars, and increasingly euros, specifically to diversify their investor base and access different pools of global capital at potentially lower borrowing costs. Every time a province adds a new currency or a new lead bank to that mix, it's making a long-term bet on which relationships will serve it best over the coming decade. The fact that euro-denominated issuance has featured so prominently in both the Ontario and Alberta deals that excluded American banks suggests these provinces aren't simply replacing American institutions with Canadian ones. They're actively courting European capital markets as a genuine alternative source of funding, not just a symbolic gesture aimed at Washington. So that's the full picture. No official freeze-out, no press release announcing a ban, but two of Canada's biggest provinces quietly stepping away from decades-long American banking relationships, a JPMorgan CEO admitting his own firm is feeling it, and record investor demand proving Wall Street's absence isn't even hurting Canada's ability to borrow. There's a reason this particular shift should worry Wall Street more than a typical trade headline would. Bond underwriting isn't a one-time sale. It's a relationship banks fight hard to protect because it comes bundled with fees, future business, and a permanent foothold inside a government's entire financial apparatus. Losing that foothold isn't like losing one shipment of steel or aluminum. It's losing a recurring seat at the table every single time that province needs to borrow money, for years, potentially decades into the future. That's likely exactly why Dimon felt compelled to mention it publicly at all. Banks don't typically advertise losing business unless staying silent would look worse than admitting it. And every additional $1 billion that flows through Barclays, RBC, or TD instead is $1 billion of future fees and relationships that used to belong to American finance, quietly moving somewhere else instead. It's also worth remembering just how symbolic bond markets tend to be in broader trade relationships. Government debt syndicates are one of the clearest signals of institutional trust between two countries. They represent a bet by the biggest financial players in the world on which relationships are stable enough to build a business around for the next decade. When that signal starts shifting away from the United States, even quietly, even with officials insisting it's coincidental, it tells global capital markets something about how durable the assumption of American financial dominance in Canada actually is going forward. Confidence in a market position like the one Wall Street has held in Canadian provincial debt for decades doesn't erode all at once. It erodes exactly like this. One bond deal at a time, one rotation at a time, until eventually looking back, the pattern is impossible to describe as random anymore. Whether or not anyone in Toronto or Edmonton ever calls this a deliberate strategy, the money is already moving without them. If you found this breakdown useful, hit like and subscribe, and let me know in the comments, do you think American banks ever win this business back, or is this shift already permanent?